All right, good morning to some, good afternoon to others. To today's call, before we get started, we have a lot of people on the call today, and I do want to make sure that everybody can see my screen and that you can hear me. If you can just type something in the questions box, that'll let me know. All right, perfect. All right, I know you guys are excited to get into today's call. I know there's great anticipation with what's going on in the world today. And this is not going to be my typical webinar. I'm usually I have a very strict set of things that I want to go through, and I go through those things, and then I take the questions and give the answers at the end. Well, I'm going to go through some things today, but I'm going to do as much as I possibly can to help you understand what it is that I'm doing during these difficult times. And I'm doing this, I'm basically giving you a strategy today that is worth a lot of money. You're going to see a trade that I'm closing out today that is just ridiculous. Literally in 2 or 3 days, what this trade was able to do. And I'm going to also give you two other trades, actually three other trades that I'm taking right now, and I'm going to reveal everything about these trades. I'm not hiding anything. I'm I'm not saying, hey, you got if you want the actual information about these trades, you got to pay for it, et cetera, et cetera. I'm giving it to you because I know that this is nuts. What we're doing, what we're having to go through right now is absolutely bat crazy. And regardless of what you think about, the seriousness of the virus, and I'm not downplaying that seriousness. The response to it is absolutely unprecedented, and because of that, it's going to create a lot of issues. And so I want to be able to help. I know that a lot of you are just taking it on the chin in some of these things, and with no hope of. I mean, really, where's the end going to be? Where's the end going to be? When's it going to stop? When's the recovery? If you take a look at the history of stock market corrections and even crashes, the recovery is ridiculously long. I mean, years. It could be years before we see stock market highs. Excuse me, stock market highs again. So that's what I want to do today, is to show you how to generate some income, some very quick income. By the way, it can be literally within a couple of days. Using some very low risk approaches, and then obviously give you the full spectrum of what the risks are of those, and you're going to see all of that in today's session as well. So before I get to the meat of this, I do want to make sure that everybody understands context, and so I want to go through the contextual part of this session before we get into the meat of it. Okay, so obviously volatility is what the issue is right now. Volatility and the market making a massive correction, but it is one of the scariest aspects for investors, traders and investors, because it really does create this sense of uncertainty. And stocks have been making historic moves on a daily basis, and the threat of an all-out bear market and crash is absolutely imminent. It's being predicted by a lot of traders, but to be clear, I'm not a doomsday fearmonger. Okay, I've never been that. I'm not that now. I don't think that things are as bad as some people are making them out to be, but at the same time, you have to look at the panic. And you have to look at the response to the public response to what is going on. And that's going to affect the economy, and that's going to affect the markets. And I've always said that we are just one news event away from a 10% drop or worse. And that can happen in a very, very short period of time. As a matter of fact, the last time I did this type of video was back in August, and I said the exact same thing. We're only one news event away from a 10% drop or worse in stocks. And if that news event gets any traction whatsoever, we're in for a 30 to 50% drop easy. And it seems like this one has definitely gained some traction. And so I don't think that we're necessarily at the end. This coronavirus has created a panic that we've never seen in this country. We have never seen a scenario where businesses have been ordered to shut down. And the threat, and again, I'm not a fear monger. I have a lot of clients across the world and in the country, and many of them are military. And I'm telling you, the whispers that I'm hearing are not good for the immediate future of how this reaction. So I don't think it's done. And if you've taken a huge hit already in your investment and retirement account, it absolutely is subject to taking some more hits. But then again, I don't know the future, and what I try and do is I try to tell people to prepare for either or of the situations. And some of you have not only taken hits in your trading accounts, in your retirement accounts, in your investment accounts, but you've also taken hits in your business. Some of you are the business owners of these businesses that have been ordered to shut down. I have a buddy who has a trucking company, and the trucking company is under severe financial pressure right now, not because he's not doing business, but because people aren't paying him. So this goes far and wide, and I know some of you are feeling it in some way, shape, form, or fashion. And again, I'm not a fear monger, but I don't think that we have seen the worst of it, just simply because I know what drives these kinds of situations. And we'll get into that here in a second. But the question is, what can you do about it right now? What can you do right now to generate some sort of income without taking a lot of additional risks? That's the question. And that's the important piece to this. And I cannot underscore this enough. I cannot downplay the importance of doing this. Most of you are at home, be honest. Most of you right now are at home in your pajamas. Tell me I'm wrong. So, this is a perfect time to learn how to generate income through the markets during these high volatile times. Because I think they're going to be. I mean, we're setting a precedent right now. If I'm just going to be honest, we are setting a precedent of how we're going to respond to things in the future. Even when this one blows over, we have set the precedent. And I'm telling you, that's not a good thing. Yeah, it's not a good thing. So this is what you're going to learn today is going to pay off in the future. Not only now, but it will pay off in the future when these things start to happen again. We have an election coming up later in the year. We've even got some people saying that there are 25% of the people who are saying delay the election because of this thing, which would be utterly chaos. That would be that. I hope we do not see that happen, because the things that the ramifications of something like that are just mind-boggling. So this is something that you're going to want to learn to do as much as you possibly can. No question about it. Okay, so that's what I'm going to show you today is how to generate this income. And I'm going to show you this exact trade that I put on this morning. the one that you see on my screen. And you'll notice here that the profit projection is well over $1,000 in a small area. Actually, it used to be a huge area, but with today's volatility, it's a small area. But that's between about 241 and 248. You're looking at as much as $1,000 profit potential. Actually, closer to $1,300 profit potential. With this particular trade, there's no risk to the downside, and the risk to the upside is small considering the move that it has to make in order to reach it. So the probability on this trade is 70% that it will make money. And a lot of that has to do with the fact that if markets crash, this is not going to lose money. It's guaranteed to make money. So there's no risk to the downside. You can structure it differently. I personally like to structure it where there is no risk to the downside, because I believe that's where the greatest risk of a major move is. Can the market move up big in a short period of time? Absolutely. But I think under the current circumstances, that one is not going to happen as often. It probably will happen once or twice over the next, several weeks or whatnot. We'll see these massive bounces, these massive single or 2 or 3 day bounces. But the circumstances just are not conducive of this being a common thing at this point. So I think the risk is that we'll see more downward move than we will upward move. And hang on for me 1 second. I need to get a drink real quick. All right. So I'm going to show you this trade. I'm going to show you exactly what it is. 70% probability. There's less than a 1% chance of realizing the maximum risk on the trade, which is about $600, is the maximum risk on this trade, but it's not going to happen until around 275. And this trade ends Wednesday. So we're talking about 3 days of market action. Will the market go up to 275? Can it? Yes. Did it? A couple of weeks ago, yeah, it did. After, we were trading at 250 one day and 270 the next day, and then below 250 the following day. So, there is that possibility, but the probability is that that's not going to happen. Actually, I think the maximum risk is actually higher than 275 on this one. Nonetheless, before I get to the details of this trade, you need to understand how this works. Because if you don't understand how this works, how volatility works, then you could make some serious mistakes and take on some risks that you don't want to take on. What I'm going to show you today, these types of profit potentials, this type of profit potential is not available outside of the current market conditions. All right, these trades are available outside of the market conditions, the high volatility market conditions, but this profit potential and the range of profit is not. And so if we see volatility shrink, the dynamics of this trade are also going to shrink. And so it's very important for you to understand this and understand how volatility works. And it's also important for you to understand how the relationship between these, what we're doing today is putting on an option spread, a limited risk option spread, no risk to the downside. And the risk is only to the upside, and the market has to make a significant move in a very short period of time to get there. And so what creates this? Well, the backbone behind every single option strategy that I trade is basically a time warp type approach. The power of PPD is a video that I put out many years ago when I first started looking at weekly options, and that it's free. You can go to paydaystocks.com, click on resources, and you can access that video for free. If you want more information about this approach, if you're not familiar with my general concept of how I approach weekly options, then that is it. And I have a lot of traders who have done very, very well with this particular type of approach. including Jim out of California, who has been trading OEX options since the 1980s, since the early 80s. And he says the PPD approach is the absolutely one of the best things he's ever learned, and that's after 30 years of trading options. So it is very important that you before you take these trades, that you understand the backbone principles that are driving the opportunities and why I do them. Because when you understand those, then you also understand the risks, right? Excuse me. So what you're about to learn, again, is also one of the most important things you will ever learn about SPY index options. So the question is, what causes volatility in options? If we need to understand volatility, and specifically volatility in stock index options, we need to know what causes that volatility, because it's a misconception to think that mere volatility in the underlying market increases volatility in the options. That's absolutely not true when it comes to stock index options. This does not apply. Very important for you to understand this. This does not apply in the same way to individual stock options. This is only stock index options, what I'm going to be talking about. So volatility in the underlying market is not what causes volatility in options. It is, it's very important for you to understand this and understand what does cause volatility. Number one, a market drop will cause volatility to be inserted into the options. Period. End of story. A market drop will cause volatility to increase in the options, even if the average daily range is, or if the market is within the average daily range. And this is a micro truth. It is something that you will see within a 1 point move of SPY, for example. And you will see this truth play out in real time within a 10-minute time frame. If the market goes from 285 to 284 in 10 minutes, you will see the at the money option increase in value. And I'll demonstrate that here in a second. Another thing that causes volatility, whether the market drops or not, is uncertainty or surprises or announcements where they don't know what the result is going to be. So an economic report, the FOMC meetings, and the prime rates being raised or dropped, or the announcements. Those types of things will create volatility in the underlying options, not necessarily the underlying market, but the underlying options. And so those are the two biggest things that create volatility in options: market drop and uncertainty. And when you have both of them occurring at the same time, you have a lot of volatility in the options. And guess what? That's what we have today, right now. So then the question is, all right, well, if we know what causes volatility in options, what then brings stability back into the market or into the options? What decreases volatility in the options? And the answer to that is certainty. So when these announcements, for example, occur, you'll see high volatility in the options before the announcement. After the announcement, even if the market reacts, you will see a drop in volatility almost instantly. Not always, but almost instantly, many, many times. And certainly within the next few hours and day. It can be devastating if you don't understand how that works in options. If you happen to buy options or use spreads that are subject to risk with option volatility crashes. All right, so the last election was a prime example of how this works. The consensus in this country was that Hillary Clinton was going to be elected president all the way up until about 8 or 9 p.m. the night of the election. And then things started to change. And it became apparent that it wasn't quite the shoe-in that everybody thought. And the overnight markets began to drop. And the more it became apparent, the more the markets dropped. And then, along about 2 o'clock, 3 o'clock in the morning, somewhere around there, it became apparent. And when I say drop, I mean they dropped significantly. I mean it was a mini crash. And then around 2 or 3 o'clock in the morning, when it became apparent that it was going to be Trump that was elected, certainty entered into the markets and they completely recovered by the open of the next morning. That is a classic example of uncertainty, people reacting to uncertainty, and then once they know something, then they react to what they know for certain. And it was just a wild thing to watch. And that's exactly the case with how volatility works in options. And so right now we have a lot of uncertainty. And one of the reasons I think that this is going to keep going is because there's too many unknowns right now. How many are going to get this virus? That's a completely unknown. I think it's far more widespread than what people think, and certainly what they're reported, because not everybody's getting tested. Just because you get a cough or a cold or cold symptoms, you're not going in, or at least you didn't used to go in and get tested for something unless it became more severe. And so a lot of these are not going to be reported. I think there's going to be a lot of people that get this, regardless of the efforts. So this revelation, I think, is going to be create some uncertainty. And then the more tests that are provided, the more you're going to see these balloon, even though the numbers probably were always high in the first place. You just didn't know it. And so because they are high, or because they will be high, I think you might see an extended period of time where these businesses are shut down. But we don't know how long they are going to be shut down. Right? So there's uncertainty. All we do know is that they are shut down. We don't know when they're going to be brought back up or allowed to reopen or whatever. And the more and the longer this goes, and the more cases that are reported, the worse it's going to get. And then how long will the economic effect of this be felt after this is all over, after businesses begin to reopen? It's going to be a long period of time, and no one knows the true long-term effect. The unintended consequences of the response of this, I think, are going to be, I think they're going to shock people. When we get through the end of this and what actually happens as a result of the response, of the drastic response that we have undergone, I think it's going to be just, it's going to be mind blowing. And I just, to kind of give you an idea, my wife and I just got back from the Caribbean. She had a business trip there planned for the last few months. She doesn't travel. She doesn't like to travel. I love to travel. And I talked her into going to this because I would get to try to tag along. So, so we went down to the Caribbean, and the day that we got there, the island announced that they're shutting everything down. They canceled our return flights home. And the resort that we were staying at, where the meetings were for her business, were shutting down. It was an all-inclusive. No restaurants were open. Pools were closed. I mean, it was just bizarre, and we couldn't get home because they canceled our flights, and then they said no one's coming into the country, and because no one else is coming into the country now, there are no planes to get out, and so it was quite the ordeal to get out. But on the way to the airport, when we finally were able to secure a flight out, on the way to the airport, the driver, we were talking to the driver, and he says, the island is completely shut down. No restaurants open, no tourism, no nothing. Which they survive on tourism. And he said he has family. And the last time it looked like this was after the Hurricane Irma, 2 or 3 years ago, and he didn't have a job for 6 months. And his family suffered, and the entire island suffered, and now he's going to suffer again. And this worldwide impact is going to be felt for a long, long time by a lot of people who, at least people in my country, in America, and I know that I have a lot of uh, foreign attendees in this, but it's going to affect a lot more than just America. And for some reason, a lot of my fellow countrymen are only looking at not getting the virus, and they're not looking at the unintended consequences. So I'm just kind of giving you the reasons why you really, really need to prepare for how to learn how to do this properly. But the ultimate end story behind most of this is how long the public is going to be forced, or is going to put up with being forced to not run their business. There's only so much tax dollars. They're talking about stimulus and aid. There's only so much tax dollars out there. And this is not going to be something that it's an uncertainty. But the longer the public puts up with it, the longer all of these other things are going to be felt. So what does this mean for the options? Well, how this works with options is that as stock market indexes move down, the extrinsic value, of the options themselves increases, and it increases dramatically. It's almost proportionate. The more it moves down, the higher the extrinsic value is inserted into or infused into the options. And as stock markets move back up, then the extrinsic value decreases. Now, it doesn't decrease as fast as it increased. And so even as the markets move back up, the extrinsic value is decreasing, but it's decreasing at a slower rate. But it is nonetheless decreasing. You can take this to the bank. What I'm telling you right now, you can take it to the bank. This is how it works. And it's very important that you understand this, okay? And I'm going to show you why it's so important here in a second. Okay, now this is relative. And so, as the market moves higher or lower, the bigger the moves, the more you're going to see the volatility being infused and taken out of these options, right? So a 287 call at the money is going to be priced higher than a 288 call when it's at the money. So it's relative to what price, what strike is at the money. And that's how I compare all of this stuff. And you can do it with out of the money. So you can say, okay, compare a 5-point out of the money now when the market is higher, or with a 5-point out of the money after the market moves down, relative to where the market is. You can do that, and it's going to be the same across the board. But I use the at the money just kind of as the benchmark standard point to look at, because it's the easiest one to look at. Nonetheless, that's how it works. So to give you an idea, when this all first started, at 1:35 p.m., SPY was trading at 284, and the at-the-money call was at 250. At 1:45 p.m., 10 minutes later, SPY moved down to 283, and the 283 call was trading at 270. So literally a move down of 1 point infused 20 cents into the at-the-money calls. And now, and this was, I think, had a week to go. Now I sold an at-the-money put option, actually it was slightly out of the money at the time, for 5 points that expired today. So that kind of gives you an idea of where we're at with the volatility in that range of how it works. Now, as a market stabilizes, okay, so if the market makes a big move and then it begins to stabilize, even if it's only within a 2 or 3 day range, and it stabilizes so that the volatility dramatically in the underlying market dramatically drops, and the market stabilizes, then you're also going to see extrinsic value decreasing. But again, it's not going to be extremely fast. It will take weeks of stability to have a significant impact on dropping the volatility. But you will see it to some degree within a day or 2 days or 3 days. So if the market tanks to 230, you're going to see an at the money option that expires in 2 days. You're going to see it, let's say, at 8 points, maybe 9 points, maybe 10 points. If the market stabilizes at 230 or around 230 for the next couple of days, that same option that expires in 2 days, okay, so you may have to go through the next expiration, but that same option that expires in 2 days at the money is going to have less extrinsic value. So when the market makes a move, it may be at 10 points. If the market stabilizes, then that same option with the same amount of time on it may drop to 8 points or 7 points or something like that. All right, so you'll see the volatility drop as the market stabilizes. Okay, now the greatest amount of extrinsic value obviously occurs at the time of the move. And once that pause happens, then extrinsic value begins to drop out of those options immediately. Again, it's not a dramatic drop, but it is a drop nonetheless. And all of this stuff is good information to have when you decide how you're going to implement it. And this knowledge that I'm giving you right now will literally unlock the door to cashing in on the volatility that exists. All right, so it's a trap for traders to fall into some of these trades that look tremendously great if they don't realize how the volatility works, because the trade changes, the look of the trade, the dynamics of the trade change as volatility changes in the underlying options. And if you don't understand how volatility changes in the underlying options, then you might make some decisions that you wouldn't otherwise make. Now, right now, we're not at as much risk of seeing a volatility crash as we were before all of this. So there are times in the past where volatility increased because the market moved down. But really, there wasn't any massive driving force. It was just maybe a normal correction or some minor things that pushed it down. Maybe the Fed didn't lower the rates or something like that that was expected. And you'd see a move down, and you see volatility increase, and then the markets would stabilize, and within days you would see volatility crash because the market didn't move down very much in the first place. We're not as much risk for that happening right now. And so, and plus what I'm going to show you today kind of puts you a little bit further away from that possibility of happening, but I'll cover that in the actual trade examples that we have. So obviously when volatility is higher, which I think it's going to remain relatively high compared to what it has been in the past for quite some time, certainly months into the future in varying degrees, but these trades are almost always available. What I'm going to show you today they're almost always available during times of high volatility. The only question that you really need to ask yourself is, okay, is volatility going to crash between now and the time the trade ends? And the probability of that happening in current circumstances is almost nil, especially with where the market is currently trading. Okay, so there are 3 key elements to behind the high probability trades that I'm going to show you. And I'm not going to go into a lot of detail on the relationship between these legs, I will mention them, but I'm going to give you kind of a blueprint, if you will, so you can kind of make the comparison on those. So the first thing is I'm going to sell nearby expiration, and I'm going to buy the very next expiration. So sell nearby and buy the very next expiration. And I'm going to show you why I do that here in a second. That's the first key. Number two, you want to always create a credit. That's not a hard, fast rule. In fact, I'm going to show you a trade that doesn't create a credit. But here's why I say this in this context. A lot of you have taken hits in your investment accounts, in your retirement accounts, your stock accounts, and those hits are going to remain for as long as stocks are down. And when stocks begin to move up, then you'll start to recover. You'll see a recovery, right? But if stocks continue to go down, you're going to continue to see a drop in whatever account you have those stocks in, unless you have them hedged, which I went over in January. I provided 2 lessons in January on how to hedge your stock portfolio. And if you did that, you are looking pretty good right now. But if you didn't, your situation is as the stock market continues to move down, I think it will, then you're going to have risk in the stock market. And if you then implement this and the markets crash, you're going to have, albeit a small risk in comparison, it is nonetheless some risk. And so if you create a credit in what I'm showing you today, you'll never have any more risk to the downside. You may not have a huge profit potential if the market crashes, based on what I'm going to show you today, but you're not going to add to the risk, in other words. And again, because these trades are only 2 to 3 days long, you have the ability, the market's not going to crash 5 days in a row. And if it does, we're going to see just unprecedented lows, at this point. So you'll see one day move down, and then you might see the market stabilizing, right? So nonetheless, that's one of the other key elements. Then the third key element is to make sure that your upside risk is always capped, and it's not just capped. You want to make sure that it's capped, but that it is also within your risk tolerance level. What you don't want to do is you don't want to create this risk, this trade, because there are a lot of different combinations that you can put on with what I'm going to show you. And what you don't want to do is you don't want to create this scenario where, if the markets move back up and your stock accounts move up, then you end up taking a loss that's equal to or significant in comparison to the amount that your stocks moved up. Now, these are all pretty low risk trades. So, even if the stocks moved up, if stocks moved up in the trade that I'm going to show you right now, if stocks move up, let's see, 10%. If that happens, you're going to see a 10% portfolio. If you put one of these trades on, you might see a 0.5% loss. In your, let's say you have a $100,000 portfolio. So your stock positions move up 10 grand. Your even in this, in a worst case scenario, you're going to lose maybe $500, $600 in a worst case scenario. And I'm going to show you how to even lower it from there. So nonetheless, the reason I say that is because there are different ways of doing this where you can create a scenario where there's actually a little bit more risk to the upside and a lot more profit potential to the downside, for example. So you're setting yourself up more for a significant increase if stocks crash. And then you're going to allow your overall stock portfolio to exceed what your risk is in that one. So there are different ways to do this. Is why I say to begin with, you want these 3 key elements. And by the way, I'm going to provide webinars starting Monday. This is now my focus. If you're wondering, this is my focus because this is what is being presented to us. Yeah, I am doing other things, but I am doing a lot of this. So I'm going to be doing another webinar on Monday, and I'm going to actually be going over another variation of this, and I'll talk about that here in a second. Nonetheless, you can find these trades manually. If you already have PDS Trader, that's your best bet to find the best opportunities, because there are a lot of different ones, and I have it set up, PDS Trader set up so that you can look at a couple of different variations of how to take advantage of these volatile opportunities. And it just kind of lists them. So you can click on, show me the opportunities that exist. It'll show you a wide range of expiration dates. And then, so for example, on this one, I have 323 expiration. That's Monday. So these trades I'm fixing to open up here and show you end on Monday. Had to take a drink. So you click compare risk graphs, and then it's going to give you a list that you scroll through, and you can just see the risk graphs that are associated with these. And you can see how the range on these is, profit range on these is absolutely huge. Now, I know that on this particular one, you're going to see debits, but I'm going to show you how to create credits, or at least maybe small debits. But you'll notice that these profit projections, based on the close Monday, which is a day and a half away, you're looking at making $1,000 if the market stays within a very large range, upwards of $1,000, and the profit potential is within a very large range. Again, I'm going to show you how to manipulate that in just a minute to create something a little bit different. So here's a trade that I'm closing out today. I placed it on March 17th. Okay, I placed this trade on March 17th. The market right before the call was trading around 243, 242-ish. And you can see here that my profit projection on this was as high as $2,000. I don't think it's going to be that. If the markets close around 241, 242, and I'm going to show you the exact trade here in a few minutes. I'm going to show you exactly what this trade is. But regardless, I'm going to make, as long as we don't see a massive sell-off or massive move to the upside by the end of the day, which highly unlikely. We're more likely to see a massive sell-off. But even if the market were to move down to 230 today, I'm looking at potentially $1,000 on this trade. There's no risk to the downside. The risk to the upside was incredibly small. I want to say it was around $250, if my memory serves correct. But again, the market would have to move up significantly in that period. So these are the types of trades that are available right now. The trade that I'm going to show you that I took this morning, profit probability, this is based on IB. This is not based on any of my stuff. So I'm showing you an independent third-party analysis of the trade. 70% the return to risk. So the max return is actually around $1,300, even though it says 1186. But that is 1.77 times bigger than the max potential risk. And the max potential risk has less than a 1% chance of occurring, because the market would have to move up very, very high in a very, very short period of time. So that's trade number one that I'm going to show you. Here's trade number two that I'm going to show you. Profit probability is 81%. Again, no risk to the downside. The max profit potential, or the return on risk, being the risk-reward ratio, is 1.56, meaning the max profit potential is 1.56 times bigger than the max loss. And again, the max loss, though, only has about a 1% chance of actually occurring, actually much less than 1% chance of actually occurring. The max probability, or the max profit, only has a small chance of occurring as well, but it has a very large range of a significant profit, as you can see. So here is the 70% trade. And again, no risk to the downside. In fact, you're guaranteed, no matter what, to make at least $50 to the downside if stocks crash today. And these trades, by the way, end Wednesday. So literally there's about 3 days on these trades. And I'm showing you the Wednesday trades because in this call, it's a little bit late to be putting on a Monday trade, a trade that ends Monday. It's not impossible to find one, but you want to get into them about 2 to 3 days out. And so this will give you what is available right now. And again, $50 minimum profit potential to the downside. The potential gain, max gain is around $1,300, and that is going to occur around 243. And so actually, I'm not sure where the market is trading right now, but that kind of gives you an idea, relationship-wise, where this is to the current market. So the only way this trade loses is if the market moves up significantly before Wednesday. We're talking maybe 275-ish, and you'll see you'll start to get into a larger loss. And when I say larger loss, $200, $300, $400. Maximum loss on this is $669. Again, that's only going to happen if you see a massive move to the upside. I'm going to show you how to lower that here in a second. So that's the 70% one. Here's the 81% one, and you'll notice that on the 81% probability trade, again, no risk to the downside, but we're not going to make as much money if the market stays relatively the same. This has a bullish slant to it. And so ideally, if the market moves up to around 255 by Wednesday, then I'm going to be looking at maybe about $1,000 profit potential. It's not going to be, this is showing over $1,300. It's not going to be $1,300. It's going to be closer to $1,000 because if the market moves up, what did I say? Volatility drops. And these projections are all based on current volatility. There is no formula that is used out there that accurately accounts for what I have just explained to you, which is a sad commentary on the mathematicians that create these formulas. Nonetheless, volatility will drop if the market moves up to 255. It won't drop a lot, but it will drop enough so that the profit potential is maybe closer to $1,000 as opposed to $1,400 in that case, or in this scenario. So here's the 70% trade. I told you I was going to give it to you exactly. So I'm going to sell 2 Wednesday expiration 244 calls, and I'm going to sell 1 Wednesday expiration 246 call, and then buy 3 Friday expiration 247 calls. You can use this as a blueprint. And the more credit you have, obviously, the better off you're going to be on this trade. Sometimes you're not going to be able to get a credit on this trade, and you have to decide, okay, it may be a 50-cent debit. And if that's the case, then you have a $50 risk if stocks crash. And I mean, they'd have to crash in order for you to realize that risk. But that would also add $50 to the risk on the upside. And that's where the risk is on this trade. And I specifically create this way for a very specific reason. So it's very important that you hear me out on this. Okay. On this particular trade, the risk is about $650. All right. If the market moves up to around 275 by Wednesday, that's about where you'll start to see a bigger loss. You probably won't see the maximum risk at that level because that'll be a massive move to the upside, but you will see a loss of some sort. But the reason I'm putting on this trade is because if stocks move back up to 275 by Wednesday, my stock portfolio will have increased about 15%, 10 to 15%. So I can afford to take a little bit of loss on the upside with this trade because I will have garnered quite a bit of profit from my underlying stock portfolio. So if you do not have an underlying stock portfolio and you don't have, this massive additional risk to the downside because of your current portfolio, then you might want to structure the trade a little bit different. That's why I say it's really important to understand what you're doing. Even though I'm giving you the blueprint, it's really important for you to understand what you're doing on this. This has a 70% probability of making money. All right, that's the break even. This is not a 30% chance of realizing the maximum loss. Okay, that's the break even point. 70% probability of at least breaking even or doing better. All right, so what are the probabilities that by Wednesday the market is going to skyrocket 275 given the current situation, circumstances, uncertainty, et cetera, et cetera? And it's very small. It's not impossible, but it's very small. And what you're going to see here is that if I can capture a profit on one trade, on just one trade, and there are 2 to 3 available each week, if I can capture a significant profit on just one trade, I will have or I have the ability to offset 2 or 3 losses with that one trade. So, given the probabilities and given that situation, this is just something that everyone needs to do to some degree. Now, this is a 2-1-3 ratio trade, 2-1-3, and I'm going to briefly talk about. I'm not going to explain it in detail, but I'm going to briefly talk about the strike differences here. And I'm going to go into this in much more detail in next week's webinars. First one being in Monday, so that you learn how to better structure these trades to create, a trade that is more in line with your circumstances. I don't know where you are, where your risk levels are, where your profit potential is, and your underlying investment accounts, et cetera, et cetera, et cetera. Right. So, nonetheless, with this, there is a short 244 calls are there are 2 of those, and there's one 246 call. Okay, and the reason there's 244 calls is because that extra 244 call is what allows me to create a credit. It's priced higher than the 246 calls, right? And so that's what's going to allow me to create the credit. The long call, which expire on Friday, are at 247. And those calls are 1 point higher than the highest strike short. And so anytime you have the long calls that are higher than the short calls, then you're creating risk to the upside. And you're guaranteed, in this situation, you're guaranteed no risk to the downside as long as you create a credit out of this. Okay. If you create a debit, then that becomes your risk to the downside. If it's a 50-cent debit instead of a credit, which by the way is still a great trade, given the probabilities, your maximum risk to the downside is only $50, and your maximum risk to the upside is going to be based on the difference between the short strikes and the long strikes. And there are 3 differences here. Okay, 3 differences. There are 2 on the 244, and there's 3 longs, right? So 244, the difference between 244 and 247 is 3 points. That's $300. There are 2 of them, so that's $600. The difference between the 246 and the 247 is $1, and there's 1 of them, and so that's $100. Whoops. All right. Sorry about that. So the difference between the 246 and 247 is $1. That's $100, which means there's $700 in differences between the strikes in these legs. But I have a credit of 50 cents. That means that you take that 50 cents off of the risk. That gives me a risk of $650. Okay. Now, if I were to move these longs or the relationship to these longs somewhere else relative to the shorts, then my risk profile changes. And that's how you manipulate these trades to create something that is more in line with what you want to create. Again, you can just use this as a blueprint if you want, as long as you understand what the risks are to the upside, significant risk to the upside, or a risk to the upside based on a significant move to the upside. And then you can get involved in that. All right, so that's trade number one. Here's trade number two. I did the exact same thing, the exact same relationship, the exact same blueprint, only I did it further out of the money. And I was only able to get a 20-cent credit instead of a 50-cent credit. So there's still no risk to the downside. But now, if the markets move higher, 255, 260, 265, I'm going to make a significant gain on these trades. And even if it remains at around 240, I'm still going to make $250, $300 on the trade. If the markets crash, then I'm still going to make $20. So I have no risk on this trade. So I'm creating a even more bullish slanted type trade. And so you can do that by just shifting where it is these strikes or this blueprint is in relation to the current market and the volatility that is in the market. And again, this ends on Wednesday. Okay, so that those are the blueprints of that particular situation. Here is the exact same trade that I took on the 17th. I forget what day that was. I think this was Tuesday afternoon. I took this on Tuesday afternoon. It expires today. I did it for $1.30 credit. And I generally, when there's a little bit less volatility, you're going to be able to get a little bit more bigger of a credit on these, by the way. So nonetheless, the 241 short 2 Friday 241 calls, short 1 Friday 243 call, and long 3 Monday expiration 244 calls for a credit of 130. There's also something else that kind of increased my credit on this, and that was the fact that it was ex-dividend. Normally, I would not ever take a trade the week of ex-dividend, which was this week. It was as of the close yesterday. And the reason that I wouldn't do that is because you're usually looking at potentially getting a sign, blah, 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 but there's so much extrinsic value that no one is willing to take the extrinsic value loss. The one-day extrinsic value loss far exceeded the dividend that they would have gotten. And so I was not worried about that. And so I took the trade anyway. But nonetheless, this is what ends today. And if the market closes between 241 and 243, I'm going to make the maximum gain. It's probably not going to be $2,000 because the volatility was a little bit higher at the time, but it's going to be significant. And the reason that that is the case is because there is value in the 244 calls. The current volatility creates such ridiculous value in these calls with such little time that you are literally taking advantage of a time warp difference, if you will, a PPD difference that is astronomical in the matter of a couple of days. And so my 241 and 243 calls, even right now, are worth a ridiculous amount of money. With hours left, right before the call, they were worth a significant amount of money with less than a day left. And so I will rapidly see these drop in the next couple of hours if the market's, as long as the market doesn't make a significant move either to the upside or to the downside. But even if it moves up, if it moves up to 250, I'm still going to make $750, $800, maybe a little bit more. If the market moves down to 230, I'm still going to make $700, $800, $900, $1,000, maybe a little bit more on this trade. I have a large range potential with this trade. So one of these, just one of these, could add 1 to 2% in $100,000 portfolio in a matter of 2 or 3 days. So it is very, very powerful. And if you're willing to take a little bit more risk to the upside, if the markets, do make a significant move to the upside, again, based on your portfolio, if that's how you're kind of looking at this, which I would strongly advise that you do, you could add 2 or 3%, literally in 2 or 3 days to your portfolio, as long as you understand, what are the ramifications if the market does move up? What is my risk, et cetera, et cetera. Okay, so I just showed you the exact blueprint that I took on trades this morning, and I took this exact same trade on Tuesday based on a Friday-Monday relationship, and it is looking like it's going to work out like a dream. So very, very, very important. Now, like I said, I always like to create a credit because of any stock portfolio that I may be involved in, which I'm involved in what's called the super portfolio rotation sector, but I'm also hedged in that. And so, with these, I have the ability to take a little bit of risk to the downside because I'm fully hedged. And if you are willing to take a little bit of risk to the downside, you can create some incredible trades that have a little bit of risk to the downside and a little bit of risk to the upside. But overall comparison between the two, it's just ridiculously small. All right, and here is that. And it is a smaller trade. It's a 112. And again, I took this trade right before the call today. And the 112, it's a short 246. Wednesday calls, short 248 Wednesday call, and long to Friday 247 calls. And that is for a debit of $2. And what this means is that I have a $200 risk to the downside if stocks absolutely crash by Wednesday. And to the upside, I have a $200 risk as well if the market closes up around 280, maybe 285. Then I'll take a $200 loss. In that scenario, if that happens, then the market, obviously my stocks will have gained significantly at that point. Nonetheless, the profit potential here is around $750 to $800 between 246 and 248. And then it has a wide range of profit potential of around $500. And the probability on this, by the way, is approximately 45%. So it's not, at least that's what IB gives me, 45%. And part of that is because if the markets do move down, I have risk. And if the markets do move down up high enough, I also have risk. And nonetheless, the maximum potential reward, maximum potential profit is almost 3.5 times my risk on this. So a 45% probability with a 3.5 risk reward ratio. Take those trades all day, every day. And you don't have to profit by more than a 1 or 2 to offset a whole bunch of losses that could occur. So high probability of seeing a profit, even though the probability of profit is only 55%, the probability of seeing the maximum loss is much, much smaller. So the average win, average loss ratios on these are astronomical, even though there's risk to both the upside to the downside. So what creates the risk to the downside? Well, it's where the longs are in relationship to the shorts. Okay, so I have a 246 and 248. You'll notice that the long is sandwiched in between. It's a 247. They're two 247s. And so that creates a debit. And because the short strikes are equidistant, one below, one above the long strike, then my risk is the same to the upside as it is to the downside. If I were to move the long strike down, then I create more risk to the downside as opposed to the upside. And that's how that works. If you learn that, you'll learn how to manipulate these trades to achieve what it is that you're wanting to achieve. And you can have a combination of these, by the way, that provides just ridiculous probabilities of success in a short period of time. So you can have one. By the way, you can move these strikes just like I did on the other trade. You can move those strikes to the upside, or you can move them to the downside, and you create the profit potential to the downside, or the bigger profit potential to the upside if you move them further to the upside. And again, the smaller the debit on here, the less risk on the trade. And there are ways to create even smaller debits, and there are ways to create even smaller risks by manipulating the strikes and the relationship between those strikes. Okay, but you can use these as blueprints. And again, it's not going to take very many of these trades working out to really begin to boost your account. And all that has to happen is for time to pass. And for the PPD, the price per day, that's what PPD stands for. The price per day on these things is just the differences on the price per day of a 1 or 2 day option versus a 3 to 4 day option is just astronomical. And so if the market, how this works again, if the market closes at around, let's say 246 on Wednesday, my 246 calls will expire worthless. My 248 calls will expire worthless. My 247 calls will still be worth $5, $6, $7 minimum. And so because of that, I'm going to make the difference between those, which will be 0, 0, and then 1,000. And minus the debit would be $800. Okay. So again, if my 247 calls are worth $5 a piece, the market closes at 246, my 247 calls are worth $5 a piece, then I will have a debit of 1,000 at that point, which means I profit $800. Okay, that's how that works. If it closes at 248, then my 246 calls are going to be worth $2. My 248 calls are going to be worthless, and my 247 calls are going to be worth maybe $7 a piece. All right, so I have a very similar profit potential right there at 247 because of the increase. After that, at 248 and above, then my short begins to be worth something. And so it's going to slowly outpace the losses in the shorts will slowly outpace the gains in the long calls until it reaches a difference of 2, which will not happen until 280, 285-ish, somewhere around there. And then you can't lose any more than $200 on this trade. Okay. So you tell me whether you think these are worth it or not. I can't imagine not having these available if in these circumstances, what anyone would do other than just wait and hope. And fortunately there's much more that you can do than just wait and hope. So I'm going to take a look at the market real quick. Looks like the market has sold off a bit. All right, so yeah, we're trading at around 230. We're trading at around 240. So that's right where I need it to trade. Get this, the 320, 240 calls. So today, like within the next 2 hours, the 240 calls, which are slightly out of the money right now, are trading at $2.36. That's with a couple of hours left. That is insane. The 240s that expire on Monday, which means between now and Monday, if the market remains at 240, they'll be worthless. But right now, the 240 calls that expire on Monday are worth almost $7, and they're slightly out of the money. They're about a point and a half out of the money. $7. That's what creates these profit potential, is the value of these long calls, because there's still 2 days on them when my shorts expired. Powerful, powerful, powerful approach. If you know how to properly structure. And I gave you the blueprint for structuring those. Okay. So you're probably saying, okay, you know what? These look really great. Again, I fully revealed them to you. You're probably saying, these look really great. I'm definitely going to put one on, but maybe you're not comfortable. Or maybe you want to learn more about it, and that's great. So let me put you back on here. All right, let's see, make sure that everybody is seeing the right one. Okay, perfect. All right, so you have the blueprint, and I'll put these back up here, by the way. But what I've shown you is just the beginning. And I've shown you more than enough for if you want to just do this, and the markets, remain within a range over the next 2 or 3 days, or over the next week, over the next 2 weeks, whatever the case is. There is so much profit potential in such a short period of time. It's not even funny. But it is just the beginning. There are a lot of questions here that obviously I'm over an hour at this point, and I wanted to make sure that I was thorough with this. I wanted to make sure everybody understood this. But there are so many different variations to this. This is just the beginning. So, for example, in next week's webinar, it's going to be Monday, 3 o'clock Eastern. The reason I'm doing it Monday at 3 o'clock Eastern is because I have some trades closing on Monday, and I will most likely replace them with either a Wednesday, Friday trade or another Friday, Monday trade. Or the markets may have moved. And if the markets move, guess what? If I have a bullish trade, so for example, if I have on this trade right here, and the markets make a big move to the upside on Monday, or the markets make a big move to the downside on Monday, I can add to this trade and again create I still maintain this profit potential. So let's say, for example, the markets tank to 225. I can put on a very similar trade now where the profit potential is at 230, 235, 232, 240, whatever the case is, no risk to the downside. And now look how much I would be covered to the upside, right? So if the markets move, I'll provide information on how to add to these trades. If the markets move and you actually might be away from the major profit zone, what do? How can you enhance the trade? I'm also going to, let me get back to this. I'm also going to show you how you can put on a further out trade. Okay, it's called a core trade. Put on a further out trade, one that expires in April sometime, and keep that core trade on, very little risk, and every single expiration between now and the core trade add $300 to $700 in profit to that trade. Monday, Wednesday, Friday. Monday, Wednesday, Friday. Monday, Wednesday, Friday. And by the time you get to the expiration of that core trade, you could have a monster profit sitting there, all starting off with almost no risk to begin with, very, very low probability of realizing any risk, even with it, and then a very high probability of creating it, becoming to be risk-free and building a profit by just simply getting in an option on or selling an option on Monday, and then when that expires, selling a single option that expires on Wednesday. When that expires, sell another single option that expires on Friday. And it's all covered by this core trade that doesn't expire until April. And it's just phenomenal. So if you want, listen, if you want to really learn this stuff, I'm going to be doing a lot of webinars over the next several weeks because of the changing conditions, and I want to give it to you real time and show you how to do it. So if you want access to this information plus additional variations, the exact trades that I'm taking, access to calls, et cetera, then I am going to give you that opportunity. You don't have to take advantage of it because I just showed you the trades. I completely revealed to you trades that I'm in right now that have tremendous probabilities. You can use that blueprint. You don't have to pay me a thing. It's my gift to you. And some of you may say, you know what, I'm going to make a couple of trades and then I'll decide whether I want to, continue learning. That's fine. You can do that. But if you want to learn, which you absolutely should, especially since most of you are at home at this point, and this is something that you can use for years and years. Anytime volatility comes, then you're going to want to do this. And this is what I'm going to give to you. I'm going to do at least 2 9/11 emergency trading webinars per week for as long as volatility remains high, provided I don't come down with coronavirus myself and can't physically do them. So, over the next couple of months, over the next 2-3 months, you're going to see 2 or 3 webinars a week where I'm showing you trades I'm looking at right now and why. Plus, I'm going to give you different variations. So you're going to see there's some crazy stuff that I'm going to show you over the next couple of weeks. Multiple 9/11 trade reports, 911 emergency trading reports per week. They're going to be brief. They're basically going to be recaps of what I have in the webinars and maybe a little bit of explanation or a couple of variations. In addition to that, so those will come out. You'll have access to those. I'm going to do trade partner signals, but you're going to want to understand the stuff. I'm not just going to give the signals. You're going to want to understand the stuff because when I give the signals, the markets may change by the time you decide to take advantage of the signal. And you're going to want to change the strike prices. And you're going to want to know how to do that. And so you can either take the trade as is, or you can change the strike prices. You're going to want to know how to do that. But those are available to you if you want them. Plus, you're going to have 9/11, 911 emergency trading, trade finder access. So the trade finder is where I showed you earlier, where you can take a look at the risk graphs. If you say, okay, show me all the risk graphs. Look, there are 16 opportunities, 16 different opportunities on 323 based on this one combination. This is a blueprint combination, if you will. There are 16 possible opportunities. You can click on compare risk graphs. It's going to show you all 16 of them. And this is what came up this morning. And so you can explore all sorts of different ways of being able to structure these trades to create some significant potential profits that can occur throughout the week. Okay, let me go back down here. So you'll get the PDS Trader Trade Finder access. You'll get access to all of this for as long as the volatility remains high within a reasonable amount of time. Obviously, if we never see volatility drop back down again, obviously, at some point, I'm going to say, okay, that's enough. We've made 10 grand off of this stuff, so you should know how to do it by then, or whatever. It'll be reasonable, but as long as the volatility remains high, I'm going to do it for the foreseeable future. Give you access to these webinars and the reports and the signals. So I'm not putting an end subscription level on this. But what I am going to do is I'm going to give you a guarantee that these trades are going to make $997 at least within the next 90 days. So, yeah, and as you saw on the trade that I'm going to exit today, I'm going to risking uh, risking no more than $450 to the upside. Worst case scenario, um, if the market's absolutely just went sky high, I'm going to end up making possibly as much as $1,500 on that one single trade today, if the market stays fairly fairly close to where they are. By the way, that one trade right now has an open position profit of $900 right now. So, if I wanted to, I could take the $900 right now and not even have to worry about waiting till the end of the trading session for the market. In case the market crashes and I drop back and only make $500-600, or if the market skyrockets and I only make $500 or $600, whatever the case is. I'm not going to do that because I'll just replace the trade towards the end of the day. But nonetheless, you can see why I'd be willing to guarantee that over the next 90 days that these trades that you're going to get in these webinars and the trade reports are going to net well over $1,000. Very high probability that they'll net well over $1,000 because I only need a couple of them to work out, and they can cover multiple losses. So I don't think I can be more fair than that, considering the fact that I've given you a blueprint that you can duplicate as often as you'd like while the volatility is high and put yourself in the position. But if you want to learn everything that there is to learn while it's happening so that you are prepared for the rest of your life, $997, you'll get access to all of that. And like I said, I'm really focusing on this right now because that's where the opportunities are. It's not the only thing I'm doing. I'm doing, for example, a super dividend approach starting in early April. And this is a great combination to that approach. If you don't have a stock portfolio, you can do the super dividend and you can do this and you can combine the two and have just a dramatic profit potential over the next several months. This, by the way, is prime for compounding. If you want to apply a compounding plan, and I'll talk about that, and I'll even give you a compounding lesson in one of these webinars about that. But prime for compounding because the risks are absolutely limited and they're fairly low. You can make them really low if you want. In fact, I want to show you a trade that's risking literally $35 to the upside and to the downside. $35 with a profit potential of around $800 to $900. So it's not the best because the probability is not as high that you'll make as big of a profit, but $35 you're risking max to the upside to the downside. And that's ridiculous. So nonetheless, if you want to go forward, it's $997. I apologize. I did not even give you the order form. So hang on 1 second. I will grab that. Like I said, I put this together because I wanted to help as many traders as I possibly could. So you can either choose to use what I've given you for free, or you can continue to move forward. So I've already had a question, by the way, that has come up quite a bit. What account size is necessary to trade this? Well, if your risk is $200 and you want to give yourself the ability to suffer that risk, 3 or 4 times, you can do this literally with $1,000. There's like no margin requirements for this, hardly at all. So that's something that you can do. And Spring, I know you're on the call. Can you give me the phone number again? I forgot to put that in the slides as well. So these guys can also call you. and get their order in. So let's see here. I am going to 412 is the phone number, 412-282-8256, and I'm going to put that in a slide here, and I'm going to give it to everybody. I'm also going to give the order form to the entire audience. So if you look at the chat, I don't know if that's my internet there we go. All right, so you see there's the phone number, call Spring, and let's just do that. Or you can go to the chat box and you can grab it now. And oh, by the way, I forgot to mention this, I'm also giving you all the basic courses to Time Warp in this package, just so that you learn everything it is possible that you can learn about this. So I am going to take questions now. Questions. Yes, it was recorded. I'm going to send you an email. You'll have the recorded email, and that will it will be a link to the recording, and you will also have the order form in that email. Let's see, Ryan. I have a time warp trade with shorts expire on 327 and a credit of 175. Is the credit too high? Oh, you have a 112 trade. Greg, I will take a look at that here in a second and let you know. I'll look at that trade specifically and let you know. Let's see. Can I show the trade finder? Let me see here. All right. So, I don't know that it's going to go over to. I don't know that it's going to go over to that. So let me see here if I can't do this. All right. Just want to make sure that it's going to show the right thing. All right. This is the trade finder, and you can see here 323, 325. If you want to look at 325, it'll show you 325, and then I'll click on compare risk graphs, and it will now show you 325 risk graphs. And you'll see a lot of different opportunities. Now, this particular strategy or this particular blueprint spreads the profit potential out a little bit more. And the way that you do that is by increasing the distance between the strikes. Again, something I'll go over in future webinars, but in this particular one, that's what you see. And you can see here, just super low risks within a very short span. We'll load more. Very large profit potential in a very large span that you can place on. And if there's any of these that you don't like, by the way, you can just click on one of them and it's going to bring up a much bigger graph so you can see, as you're about to see here. And you can see here, the break-even point to the downside on this particular trade is 230. It's not even reaching the break-even point to the upside at 260. And so just a huge, huge profit potential. You can lower this. Again, I can show you how to lower the risk to the downside or even negate the risk to the downside and just kind of put a little bit more risk to the upside if that's how you want to slant it. And again, I mean, one trade like this, and you're talking about the cost of the entire program. One trade works out. Very little risk, high probability of success. All right, so hopefully that helps. So Mitch, hopefully that was what you were wanting to see. You use SPY only for these? Yes, and the reason is because of the Monday, Wednesday, Friday. Before Monday, Wednesday, Friday, what I'm showing you did not exist to the extent that they exist now. So we're in very fortunate times to be able to capitalize on the volatility in ways that people in the past have never been able to capitalize on, which is why you're not going to see this anywhere else. People they don't know to look for it. All right, so let's see here. What do I call these? These are time warp volatility spreads. That's what I call them. In this one, it's the 911 emergency trading strategy. Because it's really the only strategy that I know of that has such small risk that you can while stocks are down, that you can literally grow your account very, very quickly while you're waiting for stocks to move back up. You are welcome, Greg. I appreciate it. Yes, Jonathan, there are videos about using the trade finder. In your example, how would it be created for risk to the downside instead of risk to the upside for a small drop in price of the stock? Steve, you put the long strikes below or at the lowest short strike, and that's how you create some risk to the downside and profit potential or no risk to the upside. You may have to manipulate the strikes a little bit, meaning that the blueprint might need to change just slightly for that, but that's something that I'll be going over in the webinars next week and the following weeks thereafter. Yes, you get access to the Trade Finder with this purchase. Absolutely. You'll have access to the Trade Finder and PDS Trade. So I will give you an absolute minimum on the PDS Trader and the Trade Finder for this of 1 year. So even if volatility drops off, in 3 months or 4 months or 5 months or whatever the case is, you'll continue to have access to the Trade Finder in case it pops back up again. What is the minimum to start? I answered that, but I just want to make sure that everybody understands this. It depends on how big your risks are. So you can create trades. For example, the trade that I talked about where it's risking $35, literally you only need $35 in your account to place that trade or available. Obviously, you want more in the account because what if that trade loses? Right? But because of how far the market has to move in order to realize that $35 risk, in that example, you would want more. If you take trades at risk $200 to both the upside and the downside, you need to have maybe 4 or 5 losses minimum in the trade or in your account. Not that, again, no one knows exactly what's going to happen, but you see the probabilities. What if you place on 5 of these trades, one that expires on Monday, one that expires on Wednesday, one that expires on Friday, one that expires on Monday, one that expires on Wednesday. What's the probability that you're adjusting every 2 days and the market makes the big move into the big loss zone or the max loss zone on 5 of those trades in a row? And you're risking maximum $200, let's say, per. Very, very low probability. I mean, just almost not even worth mentioning. So you can do this with very, very little capital available in your account. Does not require a lot at all. Are you letting most of these go to expiration? Pat, the short answer to that is yes, because I'm able to reestablish a trade, almost at the same time as expiration. And so, might as well capture as much profit as potential as possible. However, there are times where you can actually roll the trade, capturing, $900 now instead of, $1,400, but then put yourself in a position to, make another $1,400 in the next 2 or 3 days and not risk, over the next, couple of hours, seeing that 900 drop to 500 or whatever the case is. Stuff that I'll talk about much more. Short answer is I generally let the trades go to expiration. It looked like the first and second trades were the same numbers. So the first and second trade were the same relationship, different strikes. I'm going to make sure that was actually listed. So this is 244, 246. Oh my goodness, I did. I apologize. Let me change that right now. So that makes much more sense. Thank you for catching that, Mark. That makes much more sense. I apologize. So again, this is a trade that I placed on this morning. 254 strike, sold two 254 calls, sold one 256 call, and bought three 257 calls for a net credit of 20 cents. Couldn't get 50 cents credit on that one, but I was able to get 20-cent credit. And so, that moved the profit potential back up to the 255 area. 254 is actually the highest profit potential on that trade. It's right at 254. And that's why, because the lowest strike is 254. So thank you for catching that. My mistake in not making that change. If you call the number, you're probably going to get a busy signal because, or you'll go to voicemail. Leave your name and number. Spring will hold this for you, and she will get back to you as soon as she can. How can you control the margin requirements in the account? The margin requirements are always going to be based on your max risk with these. All right, so if your max risk is $600, your margin requirement for the trade is going to be $600. If you take a smaller one, where the max risk is 200, either to the upside or to the downside, your max risk, your margin requirement is going to be $200. Okay, so that's always what it's going to be in here. Can you use this strategy on individual stocks? No. And the reason is because you don't have Monday, Wednesday, Friday, Monday. It's going to be different. You can use it. For example, you can say, okay, I'm going to get into a trade. It's Wednesday, and I'm going to get into a Friday trade on Wednesday. So there's only 2 or 3 days left. You certainly can do that. The dynamics are not going to be as much or as great because you're looking at the longs that have a week left instead of 2 days left. So you may not be able to get as much of a credit, but that's what you have to look out for if you're going to apply that to individual stocks. This has nothing to do with Profit Stacker. Profit Stacker is a completely different approach. However, I am going to be showing you how to make conversions with that. So that'll be in future webinars. Do trades mainly lose big when prices move way up or way down? No. The trades that I showed you today, 2 of them have no risk to the downside whatsoever. Period. End of story. Stocks can crash. You'll make money. One of them has a maximum risk of $200 to the downside and a maximum risk of $200 to the upside. And the market would have to virtually crash to realize that $200 risk. It has to go so far that the long calls now have no more extrinsic value. And that's a long way away if the markets crash, because there'll be a ton of volatility at that point. And so, the market has to really move down for you to suffer that loss. To the upside, not so much, because as the markets move up, volatility comes out, and you'll actually suffer the loss sooner to the upside than you will to the downside. But that's why I went through explaining all of that. Thank you, ZK. God bless you. I've heard the New York Stock Exchange will close trading floor and be online beginning next Monday. How do you think this will affect the markets? I don't know. Just to be quite frank with you, I don't know, nor do I care, because at this point there's so many different things that can come in and affect the markets. There's going to be, if a state declares martial law, and then others follow, and the economics of that are just going to be awful. So, which I cannot imagine that the people in this country will put up with that, but they might. I would have never thought that we would be where we're at today. So anything could happen. With this, the trade's okay for an IRA or self-directed 401k? Yes, Tim, they are. Mike, okay, everyone needs to listen to this. Everyone needs to listen to this. All right, this is from Mike. I appreciate you writing this. I sent out a report to some existing clients on last week. And this is what Mike says. Thank you for the report from Sunday. I already made $2,000. I am absolutely joining this program. Can't wait for Monday. This week, he made $2,000 from one single report that I sent out to my clients on Monday. $2,000 from one single report. And I didn't even list multiple expirations or multiple trades. I only listed trades based on 2 expirations. There you have it from somebody who took a trade from the report. Minimum trading balance can be as little as $1,000 if you take some of the lower risk trades. If you take some of the higher risk trades, you're going to want a little more, $3,000, $4,000, $5,000 in there. If you want to do multiples, and I know some of you are going to want to do multiples because of how much you have in stocks, and there's nothing wrong with doing multiples as long as you understand the dynamics between the market moving significantly to the upside, how much your stocks will gain versus how much max loss you might lose. And I can tell you right now, if you have any significant stock holding, a single trade it's going to be minute in comparison. But again, if you have multiple stock holdings and you're at risk for further declines in the stock market, I would not put on any trades that have any risk to the downside. That's how I would structure those. And you'll have plenty of those opportunities coming up over the next several weeks. Lots of them. These trades are not doable in stable, no volatility market times. Mr. Ray, they absolutely are, but the dynamics change. And so you won't see these kind of profit potentials available in such short periods of time, except in these types of markets. But when everything begins to stabilize, if the markets move back up into some normal territory, 280, 285, 290, and stabilizes there, you're going to see a drop in volatility, and the trades will be different. You'll have lower risks on some of these, but lower profit potentials. You'll have lower profit ranges, but you'll also have lower volatility going on. So it's relative, but right now you'll not see opportunities or probabilities and profit potential like this in any other type of strategy or market condition. This is unique, and it is necessary. What's wonderful about it is that it's unique when it needs to be. It's available when it needs to be available, which is when everybody's reeling from the stocks tanking. That's when these opportunities become the most potent, when you really need them. That's why I say everybody needs to learn this as much as possible. You can create your own, Jocelyn. If you have PDS Trader, you can create your own. You have that ability to create your own trade finder. If you want the ones that I've created, you'll need to get into the package. Since I showed you, I'm not holding anyone hostage here. I didn't want to do that. I wanted to give you something that you can absolutely use. I gave my clients something last Sunday, and you just heard that one of them made $2,000 based on what I gave them, based on one single series of potential trades. I didn't want to do that. So you have it if you need it. But if you really want to learn it, and I really strongly suggest that you do, and you want to see how I'm making trades multiple times a week, believe me, the package is well worth it. But if you can't pay it, that's why I wanted to give it to you. That's at least a start. If because I know some of you are hurting really bad, and another $997 is tough. So, and on the flip side of that, I'm also guaranteeing that the trades are going to make $997 over the 90 days, or it's going to be free. So either way, I wanted to make this something to where there's just no reason for people not to be able to take advantage of it if they can. And if not, then I've given you something to create a situation where you can take advantage of it. Can you use puts too? Absolutely, Scott. I do. There's some interesting scenarios that you can do. Again, be doing a lot of you're going to have so many different trades over the next few weeks that you're going to see that are available. It's going to blow your mind to create almost any scenario that you want to create. Phil, again, so the $35, I said on a specific trade that I took last week, there's a $35 risk to the upside and to the downside. That's it. That's all the margin that's necessary. However, if you take a trade that has more risk, that's what's going to be required in margin. So if you take a trade that has $500 in risk, that's what's going to be required. What broker do I use? I use Tradeer because that's what Trade Partner is hooked up to. I'm also hooked up to TD Ameritrade, but we haven't released that yet. And TD Ameritrade also charges like 50 or 60 cents per option. They call it an exchange fee, but that's not an exchange fee. Even though they say no commissions, it's not an exchange fee. But these are, obviously these are some huge profit potential options. So yeah, you can afford the 50 cents per option. But nonetheless, I use Tradeer. I like the idea of interactive trading. Awesome. I'll be signing up. Excellent. And by the way, I see lots of opportunities based on what you just showed us. Yep, there are lots of opportunities. Great. I will see you Monday as well. Generally they're going to be, excuse me, in the afternoon. The webinars are going to be generally in the afternoon during the last hour or so of trading to give you the most up-to-date trades that I'm taking. So Mondays will be at 3 o'clock Eastern. That'll give us an hour and 15 minutes to be looking at the markets. Excuse me, I'm starting to go hoarse. To be looking at the markets and looking at the opportunities that I can take right then, right now. Let's see. Can you please repeat how to limit the risk to the downside as well as the upside? So with the downside, excuse me, I am so sorry about me going hoarse here right at the last minute. Let me pull that trade up again real quick for you. All right, so this trade has no risk to the downside. So this trade has no risk to the downside. And the reason it has no risk to the downside is because it is at a credit and the long strikes are above the short strikes. Okay, or the long strike, I should say, is above the short strikes. If that were not the case, if the long strike moves in between the short strikes, so if that becomes a 245 strike, then there's going to be a debit with the trade, and my risk will be exactly the same on the upside as it is to the downside, because the long strike will be equidistant from each of the short strikes. 1 point to lower is a short, and 1 point higher is a short. Now, I'm not even going to go further into that because that's how you do that. Okay, it's a relationship between where the long strike is compared to the short strikes is, in short, the answer. My suggestion is that you either sign up for this or you go to PDS Trader and you begin to play with some of those different variations so you can learn more about how those work. Okay. Yes, the recording will go out as soon as I'm able to get it out. It usually takes a couple hours to process. Great, Robert. I look forward to seeing you on Monday. The trade that has the risk, the $200 risk to the downside, is this one. This one has $200 risk to the downside. And the reason it has $200 risk to the downside is because the long strike is in between the two short strikes. Okay, and there's a debit, and so your risk is a $2 debit. So that's $200 risk to the downside, $200 risk to the upside. John, okay, another client who says he took the trade from the report I sent out to my clients on Sunday. He made $2,000. So there you have it again. In one report, $2,000. And you're getting for the longevity of the volatility, I'm going to give it to you for $997 within reason. That's the value. I told you I want to help as many people as I can. Sumi, thank you, Ryan. As always, you're making sense of the insane things going on. I'm looking heavily forward to using your report and portfolios. Great, Sumi. I will see you on Monday. Excellent. Can this strategy be traded in non-volatile markets? The answer is yes, but you have different risk-reward dynamics, different profit ranges, smaller profits, a lot of times smaller risks as well, but also smaller profit range. This is the one, what I'm showing you, the blueprints here are the ones that are optimal for the high volatility. When volatility is lower, they're actually better strategies, all based on the time warp, the PPD time warp approach principle. But there are better ways of applying it when volatility is lower. So these are optimal for higher volatility situations, for grabbing huge profits for very small risks in a very short period of time. Would I recommend enhancing the trades on the downside with subsequent introduction of calendar? Christopher, you bet. I can't go into that today because I do go into that in future webinars, and it's just way too in depth to start right now. But yes, you are correct. You can absolutely do that with these trades, and there are other ways to enhance them as well, which I will be showing you in the webinars. So Mike, that's a great question. If you have two of these trades with different strikes, different distances. So let's say the set of strikes are above where the market is and another set of strikes are below where the market is, you create a much bigger range. The answer is yes. The only problem though is that if you create them exactly the same way, then you have, let's say you have $500 of risk to the upside on both of them, you now have $1,000 of risk to the upside if stocks really move higher. You do create a much bigger range where you will realize a bigger profit, but you have to realize that you are creating double the risk to one side. So what you can do is you can create one where the strikes are above you and the risk is to the upside and there's no risk to the downside, and then you can create another set of strikes where the market that are below the market, where there is no risk to the upside, but there's a little bit of risk to the downside. And that's just understanding how to structure them. And again, that's something that I go over. But the principle that you're thinking about, absolutely, and it's absolutely something that I do. You can also wait till after the market moves, by the way. Hint, hint. So, all right, the order page doesn't specify time frame. That is because it is indefinite. I will give you this information as long as volatility remains high indefinitely within reason. All right. So I didn't want to put a 6-month, a 3-month time frame or a 6-month time frame. If volatility remains constantly high for the next 6, 8, 10 months, I'm going to keep doing it. And there's going to be it's going to be ridiculous, the profit potential if that's the case. It's not difficult. How difficult is it to get filled on these? Not difficult at all. So I will send trades how frequently? Probably about 3 times a week, Sean. How difficult is it to get filled on these trades? Not difficult. It's just a matter of putting the price near where the market is. If you're willing to accept the risk, then get filled. Go in and get filled. That's what I do. Or you can let it sit at a better price. And if you get filled, great. If not, you can do that. I do that on some of my other trades that require a market movement. So I'm anticipating the market movement, and then I'm going to place the trade on. I can do that. Jonathan, I will actually spend quite a bit of time doing that. I'll be showing you the process of going from the trade finder to actually making the trade on Monday. The brokerage that I use doesn't charge anything. There's no commission with the brokerage that I use. And that is Tradier Brokerage. Let them know that you are with me. There's no commissions, and their exchange fees are passed along. They're like 12 cents, which is why I know that TD Ameritrade is ripping people off, because the exchange fees are not 60 cents an option. They're literally about 12 cents. Monday is not included with today's webinar. Ron, the answer to your question is no, but for you it's yes. So how's that for an answer? When do you send the reports after subscribing to your service? So there'll be another report come out on Sunday, and what's going to happen is the reports will actually come out after the markets close. Obviously, the live webinars will be during market hours so that you can see actual opportunities and trades that I'm taking up to date and be able to place those trades. But then there'll be more information after the markets close, and then we'll repeat the process. I believe volatility is going to be high for a long time, actually. The long-term ramifications of the response are astronomical, and so there's just going to be so much uncertainty going forward. And like I said at the beginning of the call, we have now set a new precedent for how we're going to react to things in the future. So even after this, the swine flu that came out in 2009, and there are 18,000 deaths in America, 60 million people supposedly contracted this flu, 18,000 deaths. There was nothing like this. Nothing like this. So if the swine flu comes out again, if the bird flu comes out again, if any of these others, if all this dies down, we've set a new precedent. You're going to now see substantial volatility come into the marketplace for things that would not have created it in the past. It's a new era that we're living. I think we have just created a new era, and it is a new era that is going to create high volatility far more often than what we've seen in the past, which means that these opportunities are going to be far more valuable in the future than even what they have in the past, even what they are right now. Okay, for my all-in folks, and you know who you are, this falls under the half price clause, if you will. So all-in folks, this falls under the half price clause. If you're not an all-in folk, if you don't know what the all-in is, then you're not one of my all-in folks. But if you are an all-in folk, you'll get half price. Just call Spring, she'll get it to you. If you're not an all-in person and you want to know what all-in is, you definitely want to call Spring because, yeah, you definitely want to do that. All right, so let's see here. Can I exit a position on Friday and then exit on Monday? The answer is absolutely yes. If you're going to take a little bit more risk theoretically, if you were to get in on a trade today that expires on Monday, you'll take a little bit more risk. You're not going to get quite as good pricing on the trades, but you also have less time that the market can make a huge move. So the answer is yes, but you just have to be aware of that. Paul, yes, we will send you the order form. Absolutely. It is in the chat box. Can you look in the chat box and make sure that you can see that and can click on the order form if you have it? Are the graphs you're showing illustrate the profit at expiration? JK, yes, that is exactly correct. It is the profit potential at expiration. So the one that I show here, 911 emergency trading trade here, the 246, 248, 247, that is based on the expiration Wednesday. So for example, if the market closes at 246 on Wednesday, the 246 and 248 calls will expire worthless. The 247 calls will be worth anywhere from $500 to $700 a piece, meaning that the debit on the trade will be at $1,200 to $1,400. You paid $200 for it, so you'll make $1,000 to $1,200 on the trade at 246 on Wednesday if that's where it closes. That's how that works. That is correct. And that's why it works, by the way, is because there's so much value on those long calls at expiration of the shorts. Just filled as we spoke. All right. Awesome. Hopefully it works out. If the markets make a major move, you're going to want to be on Monday's call because I'll show you how to mitigate the risk even more if that happens. Are all trades in SPXW? No, these is SPY. If you want to do SPXW, you can, but I'm going to tell you right now, the SPXW will not recognize spreads. So you are charged full margin and it's for the underlying, and it's dumb. It is the dumbest thing ever. So you really can't use this in SPX. You just want to do it in SPY. But believe me, if you're trading 10 lots, which is what that would be, 10 lot in SPY would be a 1 lot in SPX. A 10 lot, you're looking at $20,000 potential profit. So I can't imagine that you need to go to SPX to cover whatever it is that you're trying to cover. $20,000, a 10 lot, upwards of $20,000 in possible profits in a matter of 2 or 3 days. It's insane. Am I closing out the long calls? Kevin, excellent question. Yes. Sorry, I always assume that people know what I'm thinking, if I think it's obvious. So I apologize for that. But yes, on the day of expiration, I am closing out the long calls. That's what creates the profit for me, is the value in those long calls still being there. So I do not hold on to the long calls after the short expires. Okay. Unless they're worthless. Then there's no reason not to hold on to them. Sean, you are too kind. I'm not so much brilliant as I am stubborn. So I hate losing. So uh, you're welcome. You're welcome, Fuzzell. All right. Looks like I got all of the questions, and apparently some of you have already been filled. Excellent.